Hi, my name is Donnell Green. I'm a mortgage loan officer. I'm here to help you with all your financial literacy and home ownership and home buying information so I can help you and your family build generational wealth. So let's talk finance. So let's go. So today we're going to be talking about credit scores and what goes in to determine your credit score. So this is a very common thing that most people just don't really know. Like, how do I get my credit score? Like, how is my score a 600? How is it a 740? What determines that? So it's important to know this because your credit score is what's going to allow any lender, no matter if it's a bank or if it's a private lender, they're going to look at this to determine the risk factor that they're going to be assessing on you when it determines if they're going to extend credit over to you, if they're going to give you that loan, if they're going to give you that credit card, whatever the case may be. Your credit score is pretty much just telling them how you've managed your credit in the past and how you're managing it now, and making sure that you will be a good client to lend out on. So let's talk about the 5 categories that goes into what determines your credit score. So first of all, just know that it's important that we understand that there's multiple credit scores for all of us. I don't agree with this, but for some reason, there's credit scores that vary from industry to industry. There's credit scores that are different in my industry, being the mortgage industry, compared to the auto industry or credit cards, personal loans. When they pull credit, you're going to get different credit scores throughout different financial industries. Also, when you pull your own credit, you're going to see a different credit score than what I would see. So it's important to know that. Some people say, oh, my credit score is this. Well, it might not be that with me. It might be higher, it might be lower. So it just really depends. And then also there's different scoring models based on the different model that's being used. So if it's a FICO model versus a Vantage score, those are going to be different also. So it's important to know that. But let's get to what goes in to determine your credit score. So again, there's 5 categories to determine your credit score. So the first part is the most important part. This is going to cover cover 35% of your credit score. That's your payment history. Payment history is very important. It's going to let the lender know whether you paid your accounts on time in the past, and it's going to let them know the amount of risk that you're going to be when it comes to them extending credit. You might not be risk at all if you're at 850, which is the highest credit score, but you might be extremely risky if you're at 300, which is the lowest credit score. So that's another important thing to know, is the range of credit score. So 300 is the lowest score that you can possibly get. 850 is the highest, and the other option is not having a score at all if you never established credit. So payment history, 35%. That's really important. Just as a tip to you, you do want to make sure that you are making sure those payments are made not only on time, but most importantly, even though you do want to make sure they're paid on time so you can avoid any late fees, finance charges, things like that. But you also want to make sure, more importantly, the most important part is not being 30 days late. That's when it's actually going to hit your credit. So yes, if you're maybe 15 days late, you're probably going to get hit with a late fee. You're probably going to get some extra charges, right? That's just a waste of money, of course. But the most important thing is making sure you're not 30 days late. Definitely do yourself a favor to avoid that whole situation. Set up an auto pay. That's the most important thing I can tell you when it comes to payment history. That's going to avoid it all. So take care of your payment history because you can't really repair that. Payment history, the only thing that's going to help it to have less of effect on your credit if you had an issue with your payment history is time, and we can't control time. Time, I say, is the most valuable thing in the world. That's the most valuable thing to me outside of God and my family. So time you can't control, you can't get that back. It's very valuable. So it's going to take usually about 7 years for those to have zero effect on your credit. Now those late payments do have less and less effect going up to that 7 years, but usually say 7 years for them completely, for all of it having zero impact on your credit. So the next most important thing when it comes to your credit is going to be 30% of your credit score. That's going to be the amounts owed. So the balances that are owed on your accounts Very important. Now, this is really going to be weighing more heavily on your revolving credit. That's what it really is looking at. So with revolving credit is going to be any type of accounts that as you're making payments on that, it allows that money that to be available to you to use again. So this is going to be for your credit cards and for your lines of credit. That is going to be your revolving credit, and that's where it's going to be really heavily weighed. So you do want to make sure you're managing that, because like I said, it's 30%. And what I will say is, like, for most of my clients, that is before even payment history. Like, I've had most of my clients, they usually have decent payment history, but what they really mess up on, and it's based on the fact of this lack of knowledge of it, because, I didn't grow up knowing this stuff, I had to learn it myself, is the way that your account balances impact your credit score. So when you have a credit card, for example, and you are, say, $1,000 credit card, and you're at $957 as your balance, that is going to hurt your credit, because you're using up a lot of that available credit, and it might indicate to lenders, and when it comes to the 3 credit bureaus that are determining your score, that you are overextended on credit. So that can be looked at as a risk. So a rule of thumb, as an important tip, write this down: 30%. Remember that number. 30% is where you want to be at when it comes to your revolving account. So this goes for both your credit cards and any lines of credit that you may have, like a personal line of credit, home equity line of credit. Those things you want to be at 30% of for a balance compared to your credit limit. So again, using that $1,000 credit limit example, if you have $1,000 for your credit limit on the credit card, you don't want to exceed $300 as your balance. And if you want to keep strong credit, if you go over that, your credit score starts to drop as you go over, and it drops heavily when you're maxing those cards out. So definitely want to make sure that you keep those balances low, 30% or less of whatever account that you have. So again, a different example, we got a $300 credit card. You don't want to exceed $90 as a balance. So just take 30% of whatever your credit limit, and that's the balance that you want to make sure that you're at or below. Now, we'll say this is another tip. One thing I found over my years in being in finance, which July will make 9 years, is that most of my clients I work with that had 800 plus credit scores, they all did pretty much the same thing. They're called transactors. A transactor is someone that pretty much, for their credit cards, they're going to pay those balances off every month. So what they're pretty much doing is they're going to put all the, normal, like gas, food, expenses like that, anything on that credit card, and then they're going to pay it off before the due date, before they get hit any finance charges. So what that's going to do is not only going to report that balance is paid down, they're not showing a balance when it's being reported, it's also going to show payment history, because they're showing that a payment was made. So that's going to help their payment history, which is that first part of your credit. But also what it's doing is it's going to keep those, for the second part, the amounts owed is keeping that low. So it's going to keep them at top tier credit. But what they're doing, which is smart, is that they're not being charged interest when they're doing that. So that's just wasting money. When you're being charged interest and you can avoid it, why not pay it so you're not getting charged, because that adds up over time. So people get stuck in this with these balances because interest keeps on rolling on top. That's really what people get hurt with when it comes to credit cards. So what they usually do is they pay them off every month, but also since they're putting on all their charges, all the gas and food, things like that, all those different expenses, they're getting different rewards from most of these cards. Like they're getting the cash back, or they're getting mileage for travel, or they're getting, points, whatever the system that they're getting. So now they're pretty much, instead of being charged by the lender, they're actually getting money in return. So they could have earned a few $100s that year, or maybe more, depending on how much they were putting on there, because usually there's no cap. So that's the smart thing to do if you have the ability to do that. Usually what these people usually do is hold that money in their bank account. They just make sure they know what they spent, so they know that they need to have that money sitting to the side so they can put that on that credit card to pay it off. So really, really good tip for you. The third part of your credit score, that's gonna be your length of history, which is 15%. So the length of history, that's going to determine a little bit about your credit based on how long you've been managing your credit. So you want to make sure any old accounts that you have the ability to keep open, you are keeping open. You want to make sure, for example, if you had a credit card that you maybe had a balance that's been running up for some years, and you heard my advice and you said, I'm gonna pay it down. I'm gonna pay it completely off. Don't close out that credit card, especially if you had it open for some time. Your length of history is important. You're going to be weighed differently from you having maybe an average of 10 years of credit history versus someone that maybe has a 1-year credit history. So if you close out accounts that have been open for some time, that will usually, you'll see a decrease in your credit score because of that. So make sure if you can keep those accounts open. Of course, anything that's a installment account, like a auto loan, personal loan, those are going to be paid off as you make those last payments. Nothing you can do about that. But usually those are going to be for an extended period of time. They're usually going to be anywhere from 3 to 5 years, sometimes more. If it can be up to 30 years if it's a mortgage. So those accounts are not bad. Those are actually going to strengthen your credit anyway, because most of those are going to be open for a few years. So nothing you can do about those. But those revolving accounts, don't close those accounts once you pay them off. And just another tip for you: a lot of these lenders, if you're not using their card, your credit card, after you pay it off, sometimes they'll try to close it out after a certain period of time if you're not using it. So just be aware of this, that you might want to here and there put something on there and then pay it off. Maybe go get some gas, pay it off. So that keeps them from closing the account out, because I hear that quite often from people, that they don't get a notification that the account is closed, which they should be getting a notification, but sometimes things happen. Maybe you got lost in the mail. Maybe they sent you the notification through email and you missed it. But either way, just another thing that can help you out. So then we have the next part of your credit score, which is going to be your credit mix. Credit mix is going to be 10% of your credit score. So that's going to be where they're going to basically take a look at the types of credit accounts you have between your credit cards, revolving, your retail accounts, your installment loans, any type of finance company accounts, and mortgage loans. And you don't necessarily have to have each type of account, but the type of mix you have does help out. And like I said, it's only 10%. It's not really much you can do. It's not, to my knowledge, I don't really know if there's a set thing that they're looking for, because it kind of varies, and it does change from the type of scoring model. Like I said, there's different scoring models, so really can't say, for example, how much you're looking for. But it is good to at least have maybe at least one credit card. Those people will probably have anywhere from 2 to 3, but at least having one credit card to show you can manage a credit card, and having some type of installment loan to show you can manage that also will be great. So if you have a auto loan or maybe a personal loan, those things can help you. If one thing that people can do that are trying to get credit established and they're having trouble getting an unsecured type of loan, like an unsecured personal loan or unsecured credit card, which pretty much means that that is not being secured by any collateral. So basically, they're just lending you money without having anything they can take back. That's what an unsecured account will be, or unsecured debt. Versus where some people have to get credit started using a secured type of account. So for example, if you're trying to get credit started and you're having trouble getting approved, you might want to look into a secured credit card. So a secured credit card is going to be a type of credit card which is going to be secured by your collateral that you're going to put down, which is going to usually be a certain amount of money. Most credit cards, they need at least $300. I know Capital One, they have one, I believe they still have one that does, you can start with $200. But basically, you're going to put your own money up there, and you're going to show how you can manage a credit card using your own money. But you don't want to look at that as like just being money that's available to you. You do want to still manage it the same way I told you before when it comes to your balances. So again, if you start a secured credit card and say you put $300 to start that is your $300. But you don't want to look at it as your $300. You want to kind of look at it as being the bank's money. Good thing is, once they upgrade your card, you will get that money back. They're gonna give you your money back, and then they'll make it an unsecured card. But say again, you're doing that $300 secured card, you do wanna make sure that you have that same rule of thumb when it comes to the 30% rule. So you don't want to exceed on a $300 secured card, you don't want to exceed a $90 balance. So you want to keep that at 30% or lower to keep a strong credit score. And also, like I said, set up auto pay so you don't miss any payments. Then we have the last part of your credit score, which is going to be your new credit or your inquiries. So that's going to be 10% of your score. That's the last part. So basically, it's not going to really reflect that great on you if you're showing that you're opening up a whole bunch of accounts, or you're trying to open up a whole bunch of accounts. That's going to show that you're a little bit more risk because you're trying to, again, overextend credit. So that's not going to be good, because the more credit you have, the more liabilities you have, the less of a chance that a lender is going to be receiving their money if you're, trying to apply for everything under the sun. So as we're on the new credit / inquiry portion of it, one thing I just want to address about inquiries. Inquiries will have an impact on your credit, but it's going to vary. Someone that maybe has credit open for, say, go back to the credit, the length of credit history, say someone that has 10 years of average credit, inquiries aren't going to have that much of an impact on that person as it would someone that's only had a year of having established credit. That person definitely will probably see more of a major drop in their credit score than someone that's been has a 10-year credit history. So let's keep that in mind. But hope this information was able to help you out. I know there's plenty of people that this can help out, so I know you probably know someone, so send this to them. Help out each other. Make sure that you can send any type of information you think will be helpful. So make sure you send this to your family, friends, co-workers, whoever needs it. Everybody has someone that they know that needs to learn about credit. Even send it to your kids. It's good for them, if they're in high school. Unfortunately, they don't teach us about financial literacy. I know it's only like 2 states that have just made it by law that they have to teach these things, but there is a reason why you're not taught these things, which I can get into on another day, one-on-one. But they pretty much don't want you to learn this stuff. So people like me, we're out here trying to make sure we can help out. I want you to be successful. I want you to be able to build generational wealth. So if you, again, share this with someone, if you need any assistance with any information, feel free to reach out. Definitely willing to help out the best way I can. If you are looking to purchase a home, definitely reach out to me. I'll be more than happy to assist you. My time is very valuable, but I work for free. I don't get paid until I get you to the closing table and get your keys in your hand. So definitely take advantage of my time and what I'm willing to give. There's no charge or anything to talk to me. So make sure that you reach out, especially if you're looking to be a homeowner, and be more than happy to assist. So again, my name is Darnell Green. Hope you have a blessed day.